Welcome to Bears in Exile. Today is May 16th, and this is our Vegas Baby segment. We'll be looking at MGM, WYNN, and LVS. And we'll start off with MGM. This is really interesting because we have two downticks. One from a few days ago and one today. And if we look for our price targets provided by the downticks, we have the one from a few days ago saying that we should hit about 1407 roundabout, and then the one from today actually states 1420. 1420. These typically take 3 to 4 bars to fulfill should they pan out, and more often than not they do pan out. So this was viewable on this day. That would be 1, 2, 3, 4 tomorrow, or the one from today, which would be 1, 2, 3, 4 would be Friday. So I would give more weight to the one that is most recent. However, that doesn't mean that this one from a few days ago is invalid. So tomorrow we'll be telling. We do have a bearish engulfing signal today, giving more weight to a possible downward move. The bar is crossing over in a bullish fashion. We noted that on a previous Vegas Baby. However, it does not have good separation, meaning it is vulnerable to being broken. It would not offer much in the way of support at this time. Our secondaries are starting to tick down. They have lots of room to move. This will be very interesting to watch over the next couple of days, but it is nice having a predictive element that seems likely to fulfill. Note also that should we hit those two targets, this bubble here will be repaired, at which time it'll be up to the stock and the chart to determine whether or not it wants to go lower. But that is the target for a repair of the bubble. Moving on to LVS. And on the daily it looks pretty bad. We have a flat line of the long-term moving average, which for the bulls is a good thing because it's better than having separation in a bearish way. So should it decide to reverse and go back up, at least the flat line will not offer resistance and it would be able to break through it fairly easily. However, the short-term moving averages are pointing down. They do look fairly uniform. We do not have signs of a bubble as of yet. Secondaries, we have room on the MACD. The other ones are pretty low, and they can stay that way. I don't think there's going to be anything to see on the shorter term time periods. We do have some wobble on the 15-minute, but we do not have an uptick. Everything's pointed down. 30-minute, uniform, everything's pointed down. 60-minute, uniform. Possibly a little bit of excessive separation, but no uptick, and everything is pointed down. So not good for LVS. And then WYNN. WYNN had a pretty ugly little candle there. WYNN has been extremely strong. Secondaries have all kinds of room to move. With this big candle, and with this space between the short-term moving averages and the bar, we do have a strong possibility for a complete crossover and separation prior to entering the bar. If that were to happen, as of right now, we would be looking at just above the 136 area as a price target for repairing a bubble. And there isn't, this sort of bubbly, but I'm sorry. I am not saying the right thing. That is not the price target for a bubble. Bubble is for a downtick, which would have been right here, just above 145, which was met within 3 to 4 bars. Actually, would have been met today. Crossing over of the short-term moving averages prior to entering the bar, and entering the bar, putting the hurt on the bar, would be right here. So, although the price is the same as what I just stated, it was the wrong terminology. So, just above 136, should we get complete crossover and it enters the bar? That would be correct. So, we are a long ways away from there. There's plenty of time for this to do something with itself and smooth this out, but just be aware of that possible target. And like LVS, there isn't going to be much to see on the shorter-term moving averages. We do have some wobble on the 15-minute. 30-minute has some possible excessive separation. Long-term moving averages are very uniform. We do not have an uptick at all. And the 60-minute definitely looks like it has excessive separation on the short-term moving averages, but we do not have an uptick. Should we get one, we'd be looking at around the 144.50 area, but we do not have an uptick yet. So something to be watching for, and definitely that can be met intraday and head on its way back down in resuming the hunt for the target over here. Definitely not as bearish as LVS by any stretch of the imagination. As always, this chart and video are for entertainment, educational, and consumption of time purposes only. All investing decisions are your own. Please drop by bearsandexile.com and check us out.